This video is created strictly for educational and informational purposes only. Nothing in this video is financial, investment, legal, or tax advice. Past performance of any ETF or stock does not guarantee future results. ETF Holdings USA is not a registered investment advisor or financial planner. All data shown is sourced from publicly available information and may change without notice. We are not affiliated with Morgan Chase or any ETF provider mentioned. Always do your own research and consult a certified financial advisor before making any investment decisions. What if you could own the biggest tech companies in the world like Apple, Microsoft, and Nvidia and get paid a massive cash dividend every single month? For decades, investors had to choose between growth stocks that pay nothing or boring dividend stocks that do not grow. But in 2026, a revolutionary financial instrument has completely changed the game forever. We are talking about the JPMorgan Nasdaq Equity Premium Income ETF, ticker symbol JEPQ. In May 2026, JEPQ is delivering an incredible dividend yield of 10.36% paid out every single month. That means if you invested $10,000 in JEPQ today, you would receive approximately $86 in cash every single month deposited directly into your brokerage account. While thousands of retail investors are struggling to time the market, smart money is flowing into this fund to build an unstoppable stream of monthly passive income. In the next 10 minutes, we are going to break down the exact strategy JEPQ uses to generate this shocking 10% annual yield paid out 12 times a year. Whether you want to escape the 9-to-5 grind or protect your portfolio from market volatility, this deep dive will reveal everything you need to know about this powerful monthly cash machine. To understand why JEPQ is skyrocketing in popularity, we must understand how it actually operates. JEPQ stands for JPMorgan Nasdaq Equity Premium Income ETF. It is an actively managed ETF launched in May 2022 that generates income by investing in Nasdaq 100 companies and selling options on that portfolio. This is not a passive index fund like FU or VTI. The professional management team at JPMorgan uses a proprietary data-driven system to select high-quality technology giants while generating extra income through equity-linked notes. JEPQ was designed as the sister fund to the famous JPI that we covered in a previous video. But while JEPI focuses on defensive S&P 500 stocks, JEPQ goes full throttle into the technology sector, giving you the best of both worlds. High growth potential from the Nasdaq 100 plus elite monthly dividend payouts that currently yield 10.36%. The fund currently manages $37.7 billion in assets, which shows enormous institutional confidence in this strategy.
Let us look under the hood at what JEPQ actually holds in May 2026. The foundation of the fund is built on the tech titans of Silicon Valley. JEPQ holds major positions in Microsoft, Apple, Nvidia, Amazon, Alphabet, which is Google, Meta Platforms, Broadcom, Tesla, Costco, and many more Nasdaq 100 companies. But instead of just holding these shares and waiting for the price to go up, JEPQ uses a sophisticated covered call option strategy. In simple terms, the fund writes out-of-the-money call options against the Nasdaq 100 index. This means other traders pay JEPQ a premium or a fee for the right to buy those stocks at a certain price later. JEPQ takes those fees, stacks them together, and passes them directly to you every single month as a cash dividend. The most recent dividend payment was 59.1 cents per share paid on May 5, 2026. This covered call mechanism is a cash-generating factory that generates income regardless of whether the market is moving sideways or slightly down. Now let us focus on the incredible dividend numbers that attract investors to JEPQ in 2026. The current dividend yield is 10.36% annually. The annual dividend per share paid over the past 12 months is $6.18. The most recent monthly dividend payment was $0.591 per share paid on May 5, 2026. Dividends are paid every single month, meaning investors receive 12 payments every year. To understand the real income power of JEPQ, let us look at the math. If you invested $10,000, you would receive approximately $86 per month or $1,036 per year. If you invested $50,000, you would receive approximately $430 per month or $5,180 per year. If you invested $100,000, you would receive approximately $860 per month or $10,360 per year. And if you reinvest every monthly dividend payment back into more JPQ shares, the compounding effect accelerates dramatically over time. Now let us talk about the incredible power of monthly compounding with JPQ. Most dividend ETFs only pay you 4 times a year, but JPQ pays you 12 times a year. The psychological and financial power of monthly compounding is unmatched. When you receive a dividend check every 30 days, you can immediately reinvest those dollars back into JPQ to accumulate more shares. With a dividend yield of 10.36%, the snowball effect builds incredibly fast. Your monthly payouts can cover real-world expenses like groceries, bills, or car payments. This is the true definition of building passive income, letting your assets pay for your life while your principal capital remains invested in the most powerful technology companies on Earth. JPQ has delivered a 1-year return of 26.2% and a 3-year average annual return of 20.8%, making it one of the strongest income plus growth ETFs available in 2026. A massive discussion happening among U.S. investors is, should you buy JPQ or stick with the original JEPI? This is an important decision for your portfolio. JEPI invests in low volatility stocks inside the S&P 500 like Coca-Cola, Walmart, and Johnson & Johnson, making it very defensive and safe during a recession. JPQ, however, is tied to the Nasdaq 100, meaning it has higher volatility but significantly higher growth potential. In May 2026, JPQ is delivering a higher dividend yield of 10.36% versus JEPI, which delivers approximately 8.93%. JPQ also delivered a stronger 1-year total return of 26.2% compared to JEPI, which is more conservative. If you are a conservative investor who prioritizes stability during market downturns, JEPI may be your match. But if you are a growth-oriented investor who wants both maximum monthly income and technology sector exposure, JPQ is the stronger choice in 2026. We must also compare JPQ to the standard Invesco QQQ ETF because this reveals the important trade-off of covered call funds. Because JPQ sells call options to generate that powerful 10.36% income, it effectively caps its own upside potential during a massive technology bull market. If Nvidia or Microsoft surge 30% in a month, QQQ will capture 100% of that gain. JPQ will capture the dividend premium income, but will miss out on some of the explosive stock price appreciation. So the choice comes down to your investing goals. If you want maximum capital growth without income caps, choose QQQ. If you want consistent monthly cash flow plus solid but capped growth, choose JPQ. Many investors in 2026 are actually combining both funds. They use QQQ for long-term capital appreciation and JPQ for monthly income generation. This combination gives them the best of both worlds from the Nasdaq 100 universe. As always, we must give you the honest truth about the risks of owning JPQ. Covered call strategies protect you in flat or falling markets because the option's premium income cushions your losses. However, if the technology sector experiences a massive prolonged crash like previous tech cycles, JEP's share price will decline along with the Nasdaq 100. The dividend income will still be paid, but your principal value will decrease. In May 2026, with global technology regulation, big tech earnings expectations, and interest rate discussions ongoing, you must be prepared for price fluctuations. JPQ does not eliminate stock market risk. It converts some capital appreciation potential into immediate spendable monthly cash flow. Investors must also understand that the monthly dividend amount is variable. Higher market volatility generally produces higher option premiums, which can increase payouts. Lower volatility can reduce monthly distributions. The expense ratio of JPQ is 0.35%. For every $10,000 you invest, you pay $35 per year in management fees. For an actively managed options fund that requires daily professional adjustments and highly sophisticated institutional execution, this is remarkably low. Many active mutual funds charge over 1%, which equals $100 per year on a $10,000 investment. JPMorgan uses its enormous institutional scale to keep fees competitive, ensuring that the maximum amount of option premium income goes directly to investors every month. Compared to JEPI, which also charges 0.35%, the fee structure is identical. For the income and technology growth exposure, JEPQ provides the 0.35% expense ratio, represents excellent value for most income-focused investors. So should beginners invest in JEPQ in 2026? JEPQ may be an excellent choice for investors who want monthly cash flow combined with technology sector exposure. Investors who want a higher yield than JEPI with more growth potential, retirees and semi-retirees who need consistent income to cover living expenses, investors who believe the Nasdaq 100 will continue growing in 2026, and people building a passive income portfolio who reinvest monthly dividends for compounding. JEPQ may not be the best choice for very young investors focused purely on maximum long-term capital growth who may prefer QQQ or VGT, investors who cannot handle technology sector volatility, and people who need a fixed guaranteed income since monthly payouts vary with market conditions. Looking ahead through the rest of 2026, JEPQ is positioned in a very interesting environment. The artificial intelligence boom is driving record earnings growth for the Nasdaq 100 companies inside JEPQ. This means the underlying stock portfolio continues to appreciate in value. At the same time, ongoing market volatility from interest rate discussions, trade policies, and geopolitical events helps maintain elevated options premiums, which supports the high monthly dividend yield. Many analysts believe JEPQ could maintain its 10% plus yield throughout 2026 if market conditions remain volatile. The fund has grown its AUM from launch in 2022 to $37.7 billion in 2026, which demonstrates enormous and growing institutional confidence in this monthly income strategy. Here is the complete JEPQ summary for May 2026. Full name: JPMorgan Nasdaq Equity Premium Income ETF. Ticker: JEPQ. Price: May 11th, 2026, $59.72. AUM: $37.7 billion. Expense ratio: 0.35%. Dividend yield: 10.36% annually. Monthly dividend: $0.591 per share. Annual dividend per share: $6.18. Last dividend paid: May 5th, 2026. YTD return 2026, 6.6%. 1-year return, 26.2%. 3-year average annual return, 20.8%. Launched May 2022. Strategy: covered call options plus Nasdaq 100 holdings. Focus: monthly income plus technology growth. In conclusion, JEPQ is one of the most powerful income innovations in modern ETF history. It solves the ultimate investor challenge by combining the world-changing growth of the Nasdaq 100 with a powerful institutional-grade monthly payout of 10.36%. Stay consistent, reinvest your monthly cash if you do not need it today, and let the power of American technology companies build your wealth month after month. Now tell us in the comments, do you prefer JEPI for safety or JEPQ for tech growth and higher income? Comment below and let us know. If you found this breakdown helpful, hit the like button and subscribe to ETF Holdings USA. We are incredibly close to our goal of 1,000 subscribers, and your support means everything. New ETF breakdown uploaded every single day. See you in the next one. This video is for educational purposes only, not financial advice.